rock star party on it. The video is live, and let's check some news. So this morning at 8:30 a.m., was anybody watching the market and see that huge reaction that came off of the news release? Core retail sales was high impact, and it actually, I don't know about you guys, on the NASDAQ, it made it crazy. Hey, good morning, Jonathan. So every morning I come to forexfactory.com/calendar. I'm going to give you guys the link in the room. And I'm just looking for high impact and medium impact, because the reality is I don't want to get caught out. I don't want to see the perfect long trade and then have news release and somebody with a bajillion dollars push that thing down against me. So that's all I use the news for. I don't worry about what they say. I don't base any trading decisions off of it. I simply know that there may be a reaction, and I choose not to step in front of that train for the most part. Guys, everything that I talk about comes from the Nexgen page, specifically the trading guide. This is where all the rules come from, all that good stuff. I did a lot of work yesterday, had a lot of fun, honestly. And one of the things I did, and I'm going to share with you, and I realize this because you guys may know, I've got a couple friends that are learning the software, and they're doing it for a couple reasons. One, to be day traders, but the other thing is they're actually helping me develop the education process a little bit. Because people that don't know me don't always tell me what they need. I've known both of these people for 30 years, and they're brutally honest. And if I say something and it doesn't resonate, or they feel like I'm missing something, they're giving me outstanding feedback. So for you folks that are a little newer, the first thing that I did is let's talk about what we're looking at. And the things that I'm going to be talking about. So this is all in the glossary of common terms, but most people won't seek it out, guys. So one of the things that you're going to hear about all day long is trigger lines. You're going to hear about large triggers, small triggers, triggers for momentum, triggers for areas breaking. So I'm going to give you this first picture, guys. There are the large triggers, and large triggers down are two red dashed lines that run parallel to one another. It's a slow moving average. That's all you need to know. You don't need to know how they're created. You don't need to know who they dated in high school. All you need to know is that when the two dashed lines are down, those are large triggers down. When the two solid lines are red and down, guys, they run parallel together. This is a faster moving average, and I'm going to go through how they work together. Same is true, just the opposite. Your large triggers will always be the dashed lines. Your small triggers will always be the solid lines, guys. And the small and the large triggers are going to work together to define not only the trend, but also momentum. So this is just kind of a roadmap. And then the second thing that I wanted to do is just areas, because we talk about areas all day long. So I wanted you to have a clear glossary, I guess, kind of a roadmap once again for what it is that you're looking at on your charts, guys. There are divergence highs, which is a magenta line. It'll print if there's a loss of momentum at a pivot. All divergence means is that the market is losing momentum. The opposite of high is low, right? So you're going to get this cyan line, a divergence low, and it will print if there's a loss of momentum at a low pivot. There's going to be Fibonacci resistance, which is going to be a red line, and when the market is trending up, this is the point where the market may stop, it may bounce, it may reverse completely, and then of course go in the other direction. Fibonacci support, it's the blue line. When the market is trending down, this is the point where the market may stop, bounce, or reverse completely. There are the mid band that's going to run through the center, guys. When price is above the mid band, it's green. It may behave as support, and when price is below, it'll turn magenta, and it may act as resistance. And then finally, there are these yellow 1-to-1s, guys. These are in the moment fibs. If price is trending up to them, they may act as resistance. And if price is trending down to them, they may behave as support. So I wanted to give you guys that. And that's kind of just the one thing that both of my friends told me was, okay, so what's a trigger? Where's a trigger? What's a large trigger? What's a small trigger? You keep saying divergence. What the F is a divergence? So guys, I tried to simplify this a little bit and put that together. And then we're going to go through the same thing that I go through every day, guys. Repetition. Doing the same thing every day so that it clicks, so that it becomes simple. And everything that I do, the repetition revolves around what we call a high probability trend trade. A high probability trend trade is only 3 rules. That's all it takes to make a high probability trend trade happen. Good morning, Kenan. We're going to talk about momentum. We're going to talk about a clear path, and then we will define an entry area, guys. And this is the same thing that I do every morning. I focus on this high probability trend trade. And if I go to the glossary of common terms, high probability trades are defined as when each indicator on every chart agrees with the rules for the trade. Typically, this is when all the triggers are their strongest, no termination conditions exist, and there's no trouble spots between you and your entry target. So guys, I focus in the morning on the absolute best of the best. This is your foundation trade. This is the trade that is gonna prepare you to begin to catch these other trades, to see these other patterns. Your high probability trend trade will lead you into what's called a medium probability trade. And this is when most of the indicators line up for the trade. You're going to utilize your ability to read charts to understand if an issue exists. And this will be the vast majority of your trades. And I think it's great that that disclaimer is in there. Probably 70% of your trades are not going to be perfect, guys. And you'll be able to execute medium probability trades. You're going to manage them a little more assertively. If trouble's in your way, you might take a portion of the position off at that trouble spot and reduce risk to a 0 loss level. So we're going to start with the high probability, because what the high probability trade does for you guys is it turns you into a chart reader. I can't overstate the importance of just being able to look at your charts and understand what it is that you're actually looking at. Chart reading is about 90% of your day every day. When you are following a plan that is nothing but advantage, you're going to find that you don't trade very often. But when you do, you have the highest chance of success. When you're chart reading, when you can look at your indicators and take that information, you will understand where the market is likely to continue. Initially, this becomes your entry for the highest probability trend trade. You'll understand where the market is likely to go. This is going to help you make good choices on targets. And finally, you'll understand where the market is likely to stop. And these are the areas that where the people that move the market are making decisions. These are the areas that can stop it cold. These are the areas that can create bounces. And you're going to be able to look at your chart really in just a moment's notice and understand these concepts, guys. And it all is derived from the high probability trend trade. These 3 rules, guys, they happen on only 2 charts. There's a large chart and there's a small chart. I had a picture of that. There we go. And your large chart is going to define really 66% of your rules. The large chart is going to give you strong trigger lines. The large chart is going to define the areas that may be problematic. And then your small chart is nothing more than a refinement tool that allows you to pinpoint exactly where the market is likely to continue. So we're going to focus on these 3 rules for the first hour. We're going to talk about them in depth. And if you really want to get to where you want to be, guys, if your goal is to be a day trader, if your goal is to win more than you lose, if your goal is to abandon that job and work in your underwear, right, while you scratch the dog behind the ear making money, there is a step-by-step path to becoming a confident trader ASAP, guys, and it all revolves around posting in the room. Post your trades in the room. Post your questions in the room. Post your pictures that have questions about your trades in the room, because every time you post in the room, each and every time you drop something in the room, guys, you're opening yourself up for feedback. You're going to know what you did well. You're going to know, excuse me, where maybe a mistake was made. I'm going to give you feedback on maybe lower risk entries, higher profit exits. And I'm going to do everything that I can in my power to give you everything in my own personal knowledge bank to make you a better trader. And the way that you get that feedback, the way that you access that, is by posting in the room. That's the most important thing, guys. And it's a little scary in the beginning. It's terrifying to post in the room and make yourself vulnerable. So I always tell new people, if you've never posted in my room, and let's be honest, even if you have, Go take a picture of your dog from your computer. Drop it in the room. Tell me its name. And let me know that you can post, because feedback's a big part of what I do every day. The second thing is use the spreadsheet. Track your real-time performance in the spreadsheet, guys. Nexgen gave you this spreadsheet. It's got 4 tabs. I'm gonna drop my copy in the room right now, and I share it every day. And I update it almost every day, so feel free to update based on mine. But the first tab on the spreadsheet it's a trade journal, for lack of a better term. Every trade you take, real-time performance, you're going to drop it into this spreadsheet. There are the directions on how to post a picture into the spreadsheet right here, how to create that hyperlink. But what you're doing is you're creating a trade journal, and you're saying, okay, this is what I did today, right? And this is how I felt, and this is what the advantages were, and this is how it turned out, and here's the feedback that I received in class. And that's all fine and great. But the most important thing that you can do is come back and study it the next day. And let me show you the picture for that. Come back the next day and ask yourself what worked. And ask yourself what didn't work, and what felt easy and what was relaxed, guys, what felt forced. Because what you're doing is you're setting yourself up to begin to recognize these patterns in the market, the ones that are bringing you success. One of the things that I'm pretty good at is recognizing the patterns in you. Some of us enter early, some of us trade into termination conditions, some of us exit early. And if I get 4 or 5 pictures from you guys, I'm going to start to recognize your thing, and you and I will work together every day to overcome whatever thing may be holding you back. But you've got to use that spreadsheet. You've got to post them in there. And there's a couple other pages on the spreadsheet as well. Everything is designed around a foundation, taking a very basic trade and then growing from it. So the second tab is where you can begin to take pictures of rules being met, begin to associate rules with looks when we talk about advantages. There is a page where you can start developing your own trading plan through the pictures that you're taking when your rules are met, so you know what it looks like, working on your management, things that you begin to see, termination conditions. And then I've taken your empty sheet and I've filled it up with a lot of stuff, guys. We've got over 350 pictures of Nexgen users using the software. These are all taken from the classroom. These aren't staged. But if you click through these, what you'll begin to see is that every one of these pictures goes back to the basic concepts of momentum, room to targets, and taking an entry, typically at areas inside of triggers. And what happens when you go through the process of seeing all of these pictures, you begin to recognize patterns. You begin to know exactly what it is that you're looking for. So make your section look like my section. Guys, take advantage of the idea that 15 hours every week, my sole purpose in life is to give you feedback on everything that you're doing. And we're going to take the first hour and we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. We're going to talk about the 3 rules, the 3 advantages, how to recognize them, how to study them. I'm going to give you study tools. I gave you my spreadsheet. I'm going to give you everything that you need to be successful in this first hour. Simulate, practice, make mistakes, be okay making mistakes, guys, but post your pictures in class. Because every mistake you make that you might think, oh my gosh, this is a failure, is an opportunity to learn. It's an opportunity to get better. It's something that's going to stick in your mind when we have the conversation about it. And then we'll work together to make sure that you're always practicing the right rules, that you're not taking the wrong trades. Because guys, your rules on the most basic plan that I provide have been proven to win more than they lose. They create an advantage every time you enter the market. And you're going to learn to focus on that. And you're going to learn to trust that. So we're going to simplify. I'm going to give you what's called the KISS plan, the Keep It Simple Sunshine plan. And this is going to be a plan that's going to optimize your chances of success. This is the plan that's going to turn you into a chart reader. This is the plan that typically wins 70 to 80% of the time. And you've just got to figure out what looks you're going to commit to. What's it look like when it's time to enter a trade? And you're going to learn those looks so that they become easy. And guys, that's where I go back to this. The more times you see strong triggers, the harder it is for you to not trade with strength. And the more times you see a clear path, the easier it is for you in the moment to recognize that there's nothing between you and your targets. And the more times you see these entries, the easier it is to time them out to get in at the correct spot. So we're going to do that. We're going to simplify heavily. Guys, I want you to get in the habit of taking 15 pictures a day. That's 300 pictures a month. At the end of 90 days of study, you'll find yourself with nearly 1,000 pictures. Pictures where you've talked about advantages, where you've recognized patterns, where you've asked questions. And then the more you study those, the more you're going to get out of those. So we're going to move forward, guys, and we're going to talk about these 3 rules. The high probability trend trade. This is a trade that typically wins 70 to 80% of the time. Guys, this is a trade, and this is my favorite. Is that this is a trade that creates confidence through the memory of success. Anything that wins that much makes you feel good. So we're going to focus on these 3 advantages, guys. Strong triggers, no terminations, and then we're going to define our entry area, and we're only going to use 2 charts. Your large chart is going to define direction. Your large chart is going to define momentum. Rules 1 and 2 are going to take care of momentum. They're going to define the areas that may be problematic. Your small chart is nothing more than an entry chart. It's a refinement chart. Your large chart takes 1 bar, the most current bar in the large chart, and guys, it's going to define all these things: direction, momentum, and area. And then you're going to go to a smaller chart when rules 1 and 2 are met, and inside of this 1 bar is about 20 to 30 bars, and you're going to use that little refinement tool to pinpoint exactly where the market is most likely to continue. And this is going to allow you to reduce your risk. It's going to help you maximize your profit potential. That's what rule number 3 is designed to do on that small chart. And we use those 2 charts because there's a large crowd and a small crowd. And guys, nobody likes to hear this, but you are smaller than the small crowd. The small crowd still pushes thousands of contracts, has the ability to make something happen in the market, and they fight the large crowd. And these are the people that are going to establish trends and create momentum and react to areas. And guys, the easiest way to get through life as a day trader is to go with the flow, go with the guys that are making things happen. But the cool thing is when the small crowd fights, you're going to be able to pinpoint exactly where they're most likely to fail. And this will become your entry point to go with the flow. So we're going to do that. We're going to start on the large chart, and we're going to define momentum, guys. Large chart needs strong trigger lines. So we talked about, what are the trigger lines? Well, there's the small triggers, the solid lines, right? They run parallel to one another. The large triggers are the dashed lines. These are what they look like in a downtrend. These are what they look like in an uptrend. Your trigger lines will actually create the trend. When the smalls break below the large, it's going to paint your background red. That means that you're in a downtrend, and your goal should be to only find rules met for high probability trend trade short. And when your small triggers break above the large triggers, it's going to paint the background green. And that green background lets you know that you should only be looking for rules to be met for high probability trend trades long. So we're going to take these trigger lines, and they're going to work together to establish rule number 1, the idea of strong trigger lines. So when the background is green, when your small triggers are green, when your large triggers are green, all the colors have to match. We're looking for separation between the small and the large. We're looking for these scissors to open. That's the visual that I get out of it. And when that space is created, the odds are favorable for the market to continue up. And when there's what we call odds favorable momentum, when you have those strong trigger lines, this is the best of the best time to use that refinement chart to buy Fibonacci support, to go with the flow, with the trend, with the momentum. On the large chart, it's going to look like a tail. On your small chart, it's going to be that full retracement back to an area, and you're going to pinpoint exactly where this tail is most likely to form. When the background is red and the market's trending down, both your small triggers and your large triggers have got to be red. If they're not, you don't have strong triggers. And then it's that space created between the two. This says to me that the odds are favorable for the market to continue down, and that odds favorable momentum is the best time to use that refinement chart to pinpoint exactly where this tail is most likely to form. This becomes your entry to go with the momentum, to go with the flow. So guys, strong trigger lines, they're not difficult to recognize. And if I open up a large chart, I think this is a crude oil chart, you can see right now on my most current bar that my small triggers are above the large triggers. The space between the two, those scissors are open. Ladies and gentlemen, I have odds favorable momentum to the upside. I had a little bit of momentum here, carried it down. Odds favorable momentum pushes it down. Once again, smalls below the large, the market pushes down. And it was that same momentum that carried the market up off of these areas of support. So odds favorable momentum, guys, is your first rule. This is a strong trigger lines. But it's not something that happens all day, every day. Eventually, those small triggers work their way back inside of the large triggers. We call this a weakening of the large triggers. And when you weaken large triggers, anything can happen up or down. So there's going to be two ways that you see charts annotated, guys. You're going to see odds favorable momentum, OFM, and you're going to embrace this. This is going to be your battle cry because momentum pushes the market. Momentum can break those key areas, guys. Momentum's even going to cover some of the mistakes that we make as brand new users. Odds favorable momentum, guys. There are trading plans built off of only momentum. Embrace it, learn it, commit it to memory, and learn to believe in the advantage that it gives. When those scissors close, when the large triggers are weakened, anything can happen, guys. And it's pretty clear in the description. The market may go up, the market may go down, the market may retrace, the market may bounce. And when anything happens, triggers hit an area, oh my gosh, they're more likely to hold. So commit right now. Odds favorable momentum. Rule number one, have that advantage of momentum every time you begin looking for a trade. And when you have it, we're going to make sure that we have room to profit targets. We're going to make sure that there's none of those likely to stop areas, those termination conditions. And guys, termination conditions, when there's none present, when you have room to the target, you will have a clear path. Once again, we are on the large chart. The large chart leads the way, and we're going to look for lines on the large chart. They're areas. Lines are called areas, but I call them lines because I don't want you to give one line more power than another line. Guys, we're going to look for divergence highs, and we're going to look for divergence lows, and we're going to look for red Fibonacci resistance and blue Fibonacci support, and we're also going to look for yellow 1-to-1s. And you guys will use the trigger lines to determine whether these areas are likely to stop the market, whether they have the potential to break, or whether or not they've broken and have established that clear path that we're looking for. So everything begins with the large crowd pushing price to one of these areas. So price reaches Fibonacci resistance. This red line could be Fibonacci resistance. It could be yellow 1-to-1s. It could be a divergence high. Guys, it doesn't matter what the line is, but when price reaches that line, all you have to do is ask yourself, where are my triggers? And if your triggers remain below resistance, guess what? This is an area that may stop the market, that may create an untradeable bounce. This is an area that might reverse the market completely. So rule number 2 says, absolutely no trades into the area because you no longer have a clear path. And guys, almost every line is going to be a termination, at least for a fraction of a second, while we wait for the reaction of the market. When the large crowd pushes down and they reach Fibonacci support, a divergence low, yellow 1-to-1s, guys, all you have to do is ask yourself, where are my triggers? If they remain above that area of support, guys, it may reverse the market, it may stop the market, it may create an untradeable bounce. So when price reaches an area and the triggers don't break, you have a termination condition. You have an area that may stop the market. When price reaches, let's find a good one, Fibonacci support, untradeable bounce. Right into resistance. And guys, this market rattled in between areas. One was resistance in yellow 1-to-1s, one was a divergence high. Here we had Fibonacci support. But the common thread is that the triggers didn't break, guys. And rule number 2 is keeping you in that 90% of reading your indicators, keeping you safe from a market that's consolidating. And you're just going to have to go back and take some pictures and learn to trust this look. But the opposite of termination is clear path, right? And the path is not clear until both your small triggers and your large triggers get to the other side of the area that was problematic. So if price pushes down and reaches support and the triggers haven't broken, guys, this is a termination condition. And there's just this moment of pause where you realize that that advantage isn't present. If the small and the large get below support, support behaves as resistance. There's one of those tails with the momentum, guys. This is when the path is clear. This is when we're looking for the rules to be met. Rule number 1 of momentum is good. The path is clear. Let's look for an entry. When the small and the large get to the other side of resistance, resistance behaves as support. The path is now clear. So guys, in the very beginning, let it be very black and white. You either have a termination or you have a clear path. Give it a couple weeks of keeping it that simple, and your ability to read your charts is going to carry you to the third option, to the medium probability option. When the small triggers absolutely smash through the area, but the large triggers haven't cleared it yet, guys. 50% of my triggers have made it through, 50% have not. We call it a 50-50 trade. Pretty clever, right? You could call it a straddle trade, a one above, a one below trade. I don't care what you call it, but it relies on odds favorable momentum. It takes that advantage of momentum with the smalls through and the large not, and it lets me know that this area has the potential to break. But it's not broken yet, because the only way an area is broken is if both the small and the large get through. So when you've got this look, this 50-50 look, guys, that potential is there, but rule number 2 isn't met. And because rule number 2 isn't met, that's going to be the issue on the chart. You're going to rely on that momentum. You're going to look for the best entries. And guys, I'm going to give you a plan to be able to capitalize on even when the areas aren't broken, but you're utilizing that potential for it to break. And everything starts. Almost every trade that Nexgen teaches suggests having a strong top or bottom, having a key Fibonacci area that reverses the market. So we're going to define a strong top and bottom, guys. It begins with a termination condition. So you've got to understand that if price reaches an area and the triggers remain below, none of the triggers break through, that's a termination. Is everybody good with that? Identifying a termination, because this is going to save your bacon 1,000 times over. This is the most broken rule by new users and honestly kind of veteran users too. Terminations may stop the market. It may reverse the market. When they do, when your large triggers roll from green to red, we're going to call this a strong top. And a strong top is the precursor to having the highest advantage. Taking trend trades, taking 50-50 trades, taking HVA trades, taking momentum trades. A strong top will set you up for the highest chance of success to go short. And a strong bottom will set you up for the highest chance of success to go long, guys. So rule number 2, honestly, is just being able to recognize the lines on a large chart and letting your triggers tell you whether they have the potential to break, whether they're going to stop it, or whether it's already broken. Is everybody good? Can you give me a why? I love it when you guys play along. I know that if you're brand new, you're like, what the actual F, Novak? And I promise, the more you study these lines, if you go back and you open up a large chart and you just start scrolling back and you see how often these areas stop the market, how often these areas create a bounce, how often these areas make things untradeable, then you begin to develop the trust in the idea that you shouldn't be trading into key areas, that you shouldn't be hoping areas break, because it's always more advantageous to allow them to break. Do you guys see it? This one had the potential, but it sure enough didn't. And it came all the way back to support, and it's starting to bounce up, guys. Rule number 2 is a bacon saver. It happens on the large chart. But there is one termination condition that I will respect on a small chart. One time on a small chart, when I'll say to myself, egads and little fishes, the path isn't clear. And that's 3 divergences. 3 of those losses of momentum from a low, 3 of those losses of momentum from a high tells me that the market may reverse. It may terminate the trend. It might, it could, the potential is there. Never a guarantee in trading. We never know what's going to happen, but we know that if it may terminate the trend, then trading into that condition removes our advantage. So 3 from a low and 3 from a high will help you identify change that you can't see on a large chart. It'll help you see through those smaller fluctuations when the trend may be changing. It becomes more powerful with those anything can happen triggers, straight out of rule number 1. And it becomes even more powerful when the third pivot is higher than the previous from a low or lower than the previous from a high. It creates a little head and shoulders pattern there. And the cool thing is that if you pinpoint one of those entries and you're in that trade and a third divergence prints, it gives you the ability to protect profits, to get out of that trade, to say, hey, things might be changing. I need to get out before they do. And that'll work its way into management as well. So, guys, rule number 2 is designed to keep you from trading into areas that may be problematic. Rule number 2 is very much going to force you to embrace the idea that 90% of your day is spent reading charts and 10% is trading. Rule number 2 is going to help you identify consolidating markets that get caught in a channel, whatever you want to call it. Any of you that come to me with trading experience, most of you tell me, hey, you know what? I lose the most often when the market is consolidating. I think most people do. Nexgen users have rule number 2 to help them identify not only when the path isn't clear, but you can clearly define the range where that consolidation is happening, and you can wait for a breakout to get outside of that range. And guys, the difference between successful traders and unsuccessful traders, and I put this on the rule number 2 lesson, it's very often the ability to do nothing when there's no advantages present. And that sets apart the people that find success every day, in my experience, and the people that are still struggling. Is rules provide a statistical advantage. Rules are going to give you momentum. They're going to give you a clear path. They're going to define your entry. And the sooner you learn to do absolutely nothing when those advantages aren't present, when you accept that trading isn't about the action, but rather the inaction, guys, that's when you start to find success. So we've got the large chart giving us strong triggers. We've got the large chart giving us no termination conditions. We are walking into the small chart with the advantage of momentum as well as a clear path. And we're going to use that refinement chart, guys, and you are going to be able to pinpoint with such amazing accuracy that you're going to use a limit order to buy or sell a pullback, that little shove that's created by the small crowd, and you're going to do it with such accuracy that you're going to have that limit order waiting at areas. Fibs, midbands, yellow 1-to-1s, guys. We use areas on the large chart to define problems. We're going to use areas on the small chart to define entries. But here's the deal. They need to be inside of triggers, guys, those moving averages. And we're going to use the refinement process. 1 bar on the large chart tells me down. One bar on the large chart tells me that momentum is present. One line on the large chart, 1 bar, tells me that this area has the potential to break. And guys, at the very bottom of this bar, when you think life is over and you're not going to make any money, the small crowd kicks in. And inside of this 1 bar, there is a full retracement all the way up to areas inside of favorable large triggers. And there is a move in the direction of your trade, guys. And all I did was put a box on 1 bar, and you can see how many bars are inside it. It's this X-ray, this refinement, that's going to reduce risk. It's going to maximize profit potential. And you'll be able to pinpoint areas inside of what we call favorable large triggers. And we embrace the idea of favorable large triggers, guys. I want you to use that as a part of your annotations. Because these moving averages, these large triggers on the large chart and the small chart, they're just the point where price tends to correct to. There's mathematical stuff in it, but I was an English lit major. But when price pulls away from large triggers, it tends to pull back to large triggers. And it doesn't matter what time frame it's on. Whether it's the big chart, you'll see it pull away and pull right back to those large triggers. And even on the small chart, you'll see it pull away and pull back to those large triggers. So my brother, in all of his wisdom, took the large triggers from both charts. He's got large triggers on the small chart defining momentum, and he took the large triggers from the large chart and superimposed them, called them synthetic triggers. They look like they have steps on them. But when the large and the synthetic are overlapping, one on top of the other, tight as they can be, two snakes riding piggyback, guys, this is what we call favorable large triggers, because what it does is it takes the correction point from the large chart and the correction point from the small chart and turns them into one correction point, only one point where we expect price to return to. So favorable large triggers are going to reduce risk, and favorable large triggers are going to help you pinpoint entries, because the tighter they are, you're running out of room to stack areas inside of them. And our trades originate not at those triggers, but rather the areas inside. So to pinpoint what I like to call the window of opportunity, the point where the market is most likely to bounce. And guys, this is the one that you're going to have to practice a little bit. The first thing is that the rules are met on the large chart. The large chart says up. The large chart has momentum. The large chart has a clear path. And you're literally going to wait for the small crowd to fight. You're going to wait for a reversal bar. It signals the pullback. That small retracement counter to the underlying trend. At the time of the reversal bar, that's not your entry, guys. We don't get in on the reversal bar. The reversal bar is actually a little bit of a loss of momentum here. Thank goodness. Because we need it to push back. So once the reversal bar prints, I'm going to identify those favorable large triggers. I might even put a circle around them. The point where I expect price to correct. This is what I call it the correction point every day, because I expect those price bars to get back to large triggers. But guys, I don't expect large triggers to create a bounce. They're a moving average. I expect areas, fibs, mid bands, yellow 1-to-1s inside of favorable large triggers to create that bounce. The areas inside of the triggers, guys, it's like a brick wall and you're kicking a ball or throwing a tennis ball, and you just don't expect it to bounce until it hits the wall, right? None of us have ever chucked a tennis ball at a wall and had it stop a foot short and then come right back at you. It always equal opposite reaction. There's some physics in there, I guess. But you're going to create a window of opportunity. You're going to be able to recognize where the market is most likely to continue. And that window will extend for a long trade from the highest point of support, in this case it's a mid-band, to the lowest point of support, which happens to be yellow 1-to-1s. And this blue shaded box is where I anticipate the bounce, guys, and it's probably 7-8 ticks wide sometimes. But I'm going to activate my limit order just at the top, just above the highest point of support. And I'm going to put it at 2 ticks, maybe even 3 ticks above it, because the large chart is screaming to the upside. The large chart has absolutely nothing to create a bounce. I don't expect the small crowd to push low, but I'm prepared for it if they are. And any line beyond the correction point is not a part of the window, guys. This is where we're hoping the market doesn't go if this is going to be a successful trade. And I want to stress real quick, the word areas inside of favorable large triggers, and Pete, you kind of reminded me with that. Everybody gets hung up on mid-bands. Mid-band trade, mid-band trade, mid-band trade. Guys, it's areas. The market doesn't care if it's a mid-band. The market doesn't care if it's a 1-to-1. The market doesn't care if it's a fib. We just need something solid for it to bounce off of. So in this case, the mid-band happens to be the highest point. And if it goes all the way down to the 1-to-1s, we're cool, guys. And that loss of momentum doesn't scare me, because that loss of momentum is only on a small chart. I need that loss of momentum to get back to my entry. The small triggers turning against me doesn't scare me. Momentum is defined on the large chart, and you will still have odds favorable momentum during the pullback. So guys, that's a long entry. Short entry is the exact same thing going the other direction. And this is the wonderful thing about futures. Who cares if it's going up or down? I don't. I can make money both ways. When the large chart says down, when the large chart says momentum, when the large chart has a clear path, come on, small crowd. Give me that reversal bar. It's not my entry. This is only the beginning of the fight, guys. It signals the beginning of the pullback. I'm going to find my favorable large triggers, and I'm going to remind myself that my entry is not impact on the favorable large triggers, but rather the areas within. And then maybe this is why everybody is so hung up on mid bands. That's the only line that I have in here is a mid band. These 1-to-1s, those fibs, they're all beyond the correction point. So I have one line inside of favorable large triggers. Guys, my window of opportunity is one line wide. My job is to activate a limit order a couple ticks below it and hope that the small crowd gets there. And I don't worry about the divergence, and I don't worry about the small triggers rolling. All I'm using the small chart for is to define my entry, to establish my point where the market is most likely to continue. And I always encourage new users, give it 20 days. Give it 20 days of being able to identify this entry. Give it 20 days of picking out your window for shorts and picking out your windows for longs. And what you'll find is that not only do you understand exactly where the market is most likely to continue, but by using that correction point, those triggers, those areas within, you're going to understand exactly where the market shouldn't go. And this is where your initial stop will be placed, guys. And even where your stop's going down the line as you begin to hold for bigger moves. But the market shouldn't go beyond the areas inside of favorable large triggers. The market shouldn't go beyond those trigger lines, beyond that correction point. If it does, if the small crowd has it in them to create that push, I don't want to be in the trade anymore. My advantage is gone. And I'm going to have a protective stop waiting. And I will take a loser. And guys, I'm going to tell you right now, losing is a part of winning. Losing is a normal part of a positive equity curve. Losing is a cost of doing business. But the key, the key is make sure that your losers are the trades with the advantages. Make sure that you're not giving away money by not having rules bet, by forming opinions. Make sure that you're not just giving away money without momentum, without clearly defined areas, guys, because there's a lot of times where you just got to do nothing. But when it's perfect, make them come get you, guys. And this will be your initial stop. And with all of those advantages present, it's not uncommon to get the reversal bar in the direction of the trend, whether it's up or down. This is the signal that, hey, guess what, D? All that momentum is pushing it down. That clear path is pushing it down. That bounce is pushing it down. And you'll actually reduce your risk a couple ticks above that reversal bar, below that reversal bar. And guys, you're going to be able to enter with such precision that it's not uncommon that even if this is one of those 20 to 30%, you get a reversal bar, you reduce your risk, and you're out $30 or $40 per contract rather than $120, $200 per contract, putting stops way beyond corrections, putting stops where the market just shouldn't go. Good morning, Miss Cindy. So the goal is that you guys all think I'm full of crap, and you go back and study this. I know, right? Weird goal. To go back when there is momentum, to go back when the path is clear. And if you see one of those tails, guys, circle it. And if that circle lines up with areas inside of those favorable large triggers, you now have a high probability trend trade. You now have a trade that typically wins 70 to 80% of the time. You have a trade that shows you exactly how to buy low, and you have lines on a large chart where the market is likely to go, and you know exactly where your profit targets need to be. The more time you spend focused on the high probability trend trade, guys, the better chart reader you're going to be, the more patterns you're going to recognize. This is one just straight out of the spreadsheet that I gave all of you. Odds favorable. We haven't reached the area. And guys, everyone's like, but Mark, there's only 4 ticks to get to that nasty little line. Guess what? You buy pullbacks to areas, and suddenly that 4 ticks is 5 points. And guys, this is the entry. This is the one that creates manageable trades. This is the one because you wait for the pullback, reduces risk. This is the one because you wait for the pullback, gives you room to get to your targets. And it looks exactly the same inverted. Odds favorable momentum has got to lead the way. Price doesn't reach the areas. There's room to the targets. Let's let the small crowd do their thing. enter at an area inside of favorable large triggers, and make a little money more often than not. Create that confidence, guys. And that is my first hour. Every hour, guys, every hour, I say the same darn thing. Let me give you the PowerPoint that I used to teach the first hour. Every hour, you guys get 3 simple rules. Every hour, I'm going to give you something to learn how to teach them. Every hour, we look at those rules, keeping you out of trouble. Rules not met. Triggers don't match. I don't have momentum. Path isn't clear. Guys, what you're looking at right now is consolidation. The sellers had it full tilt boogie right off that termination condition, and they took it all the way down. And now you're watching the fight as the buyers and sellers try to figure out who's going to win this fight. So 3 simple rules, guys, focused on the absolute best of the best. That's what we do every morning. And now I'm going to give you the tools to study. And the first one is going to be Chart Reading 101. And I'm a huge fan of this one. Everyone that's used this the feedback has been, man, I'm such a better chart reader. Man, it's so much easier to recognize these things quickly. So in order to get to where you want to be, guys, you have to be able to recognize some looks and patterns pretty quick. And this is going to reinforce the lessons that you get every day. And this is going to speed up the process of becoming a chart reader, guys. So your job, if you're serious, right? If this isn't just a little, oh, I think it'd be cool. But if you're ready to turn this into a career, if you're ready to create that confidence, guys, 25 pictures each. Strong triggers, so you always trade with the advantage of momentum. And weak triggers, so you know exactly what it looks like when that advantage is gone. 25 pictures of a clear path, so you never get caught out trading into areas that may stop the market. And then 25 pictures of termination conditions, so you know exactly what it looks like when you've arrived at trouble. And then take 25 pictures of that 50-50 look, that potential to break. And you'll have the realization that that 50-50 look does not always beat the market. And I'm going to give you a plan on how to take those. And then pictures of pullbacks to areas inside of favorable large triggers, guys. But the idea is don't just take the pictures. Don't take them, throw them in a spreadsheet, and never look at them again. Annotate your chart, write on your chart, and talk about the whys. Why are the trigger lines strong, right? Well, it's the separation between the two. It's those scissors open. What's the advantage? The advantage is the momentum, and that goes with rule number 1. And why is it a termination condition, guys? In this whole section, this 101 section, I've given you a huge head start. But if you click on a picture, strong up, what does it look like to have strong triggers up? Well, it looks like smalls above the large. The trend is up. The background is green. The smalls are away from the large triggers. This is strong triggers. I've defined it perfectly. And then if I go to weak, what's it look like to have weak triggers? I'll be damned. Those smalls are inside of the large. There's a loss of momentum. Anything can happen. And guys, this is the easiest way to get there. Don't wake up on day 1 and say, I'm going to find trades. Wake up on day 1 and say, I'm going to learn advantages, guys. And this 101, Chart Reading 101, is going to help you do that, and you're going to be able to do it quickly. And you're going to be able to do it confidently. So let me drop that in the room. You might be saying to yourself, but Mark, I just learned this. How on earth am I going to be able to take pictures of it? Well, you know I think of everything, guys. I'm going to give you the high probability trend trade checklist. This is going to do a couple things for you. First, it's going to give you something to write on your chart when you look for trades. It's going to remind you verbally exactly what it is you're looking for. I'm looking for odds favorable, large trigger momentum on both of my charts, right? Print this out, put it on your desktop, take the most delicious crayon you own and make sure that you mark yes to each of these. And I've never had anybody be able to do that and do worse than 70%. So if you're coming back to me and you're struggling with consistency, right? I see some names in there. This is a great way to get it back. And then for you new users, this is exactly what it looks like. That's a termination. There's the reversal. Well, there's a strong bottom. I even gave you a link to my brother being pretty smart talking about trigger line location. This is your odds favorable, and this is your anything can happen. This is your strong triggers, and this is your weak triggers. No triggers through, not broken, no clear path. Potential to break, area broken. Guys, you should never get confused if you go through this study. Window short, window long, telling you everything. What starts the pullback, where your limit order goes, what's not in the window, and what defines your window of opportunity. So guys, here's the high probability trend trade checklists. And again, never had anybody follow these checklists and do worse than 70%. And then finally, the piece de resistance, if you will, guys, the KISS plan. The Keep It Simple Sunshine Plan, because HR said I can't call anybody stupid. Guys, this is a stepping stone. This is a stepping stone in your learning journey. This is the beginning, the foundation, the alpha, the solid platform from which you will grow. And guys, it's designed to optimize your chances of success with the high probability trend trade. It's designed to give you the highest chance of winning. It's designed to turn you into a chart reader. It's designed to build confidence. And then through simulation, through study, through class feedback, through continuous practice, you will be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That's my brother playing with AI, guys. And what it says is that when you can read your charts, you're going to see a lot of opportunity. But here's the deal. Your chart reads are not rules. Your chart reads let you know that the rules are met. So your simple plan for consistency, guys, never fight the large chart. Never fight the large chart. Because the large chart defines everything. It defines momentum. It defines areas. It defines all of that. Pete, they did have a note on their site that said that they're going to reset balances. They also had a note on their site that said stop trading Tradeovate. It's all left up. So be a sim warrior today, but they did mention on their customer support that they're going to make it right. So I'm rooting for you guys that are still with Apex. Let's talk about how to commit financial suicide. Good morning, Ed. Nickel's on the way. Warning signs your friends are in trouble. They're trading against strong triggers, guys. Strong triggers are established by the large crowd. Strong triggers are established by the people in charge. Strong triggers let you know that the market is likely to push in the direction of the trend. Don't fight strong triggers. And then chapter 2, termination conditions. Termination conditions are where the people in charge are reacting, where the buyers buy, where the sellers sell. Termination conditions, you know without question that they may reverse the market or create an untradeable bounce. If you can commit to these two, don't fight the large chart, guys, I'm telling you right now, you're going to eliminate probably 60 to 70% of the mistakes that new users typically make. And it means that you have to be patient. It means that you have to wait, that you have to embrace that 90%. Define your entry. Let it be your entry. This isn't Mark Novak's high probability trend trade. This is Jonathan's high probability trend trades. This is Trimper's high probability trend trade. This is the Tooth Plumber's high probability trend trade. Make them your rules. Commit to your rules. Hold yourself accountable to trading these rules. And guys, all this does is define where you're going to get into the market. It is a very mechanical approach to getting into the market. It is an opinionless approach to getting in the market, and eventually it becomes an emotionless approach to getting in the market. Once you're in the market, you've got to do something with that great entry. And man, your great entries, they will create manageable trades. You will craft a plan tailored to your personal goals based on your experience reading the indicators. That magical phrase that says, hey, guess what? Once you're good at reading your indicators, once you can do that quickly, your management plan is going to change. But until you have that ability, your management should be just as mechanical as your entry, guys. So in the KISS plan, I give you the most emotionless mechanical plan that I could ever offer anybody, and it begins with getting in where the market is most likely to continue. If you do not figure out this piece, your trades are going to be more difficult to manage. Your risk is going to be bigger. Your profits are going to be lower. So be willing to get in where the market is most likely to continue, and be willing to put your stop where it shouldn't go. 4 to 5 ticks beyond that window of opportunity, and be just surrender completely to the idea that you may get stopped out. Every 10 trades you take, there's a good chance you're going to lose 2 to 3 of them if you're following the rules. But revel in the fact that more often than not, you're probably going to get that reversal bar in the direction of your trade. And when you get that reversal bar in the direction of your trade, you're going to be able to reduce your risk. Where the market shouldn't go, Rob, is a good rule. It's hard at first because it means that you have to be willing to lose. And guys, that's not easy for a lot of people. And that's why Simulator is so amazing to develop that trust. Guys, if I get a reversal bar, my risk is reduced. And there's nothing for me to do once again. I'm not going to pull my stop super tight. I'm not going to put my targets in a place where panic is leading the way. I'm going to keep it very if-then. If I get a reversal bar, then this is my stop. And there's nothing for me to do until it either hits that stop or it gets to my first target. So you KISS planners, this was on purpose. Your first target is $100 away. Your first target is 8 ticks on the S&P, only 10 ticks on crude oil. And that $100 creates a boatload of confidence, and it dries up all the sweat from your palms, and every butterfly that was going nuts in your stomach quiets down because you just got paid and your confidence level is high. And then you're going to move your stop to break even. This is your new stop. Not only did you put money in your account, but you also have nothing to lose. And guys, it's either going to hit you break even or it's going to go to your second target. And I'm going to tell you right now, in all honesty, 2 months from now, you probably will never go break even because that's not the best stop. But for the brand new user, I can't think of a better stop because you have to remove that fear of loss. And that's what allows you to hold for the second target. And the cool thing is if it hits the second target, only $200 away from your entry, only $200 away from the perfect entry with every advantage. Guys, this is a $300 trade. This is a $300 trade that, from the look of it, probably ran a lot further. And you will create a trading plan based on your ability reading the indicators that ultimately will allow you to hold for those bigger moves. It'll let you recognize advantages, maybe on the large chart, that say, let's hold for bigger moves on the small chart. But until you get there, get paid. That's the goal, guys. The whole goal of being a day trader is to get paid. This plan is the easiest way I've ever taught anybody to get paid. Take the correct entry and manage it without emotion and learn to trust your indicators. And guys, you will find 1,000 ways to make money in the market. But the high probability trend trade is the easiest. It's the fastest. It's the one that teaches you the chart reading. And honestly, this is a plan that you can be profitable while you're learning to become a chart reader. And I've had people follow this plan that I'm giving you right now to the letter in their first 30 days and get funded in those prop firms and make consistent profits and find that 70, 80, 90% win range. And the second trade, once you're a chart reader, once you can identify momentum in a clear path, once you can pick out that entry area, when you start to get in tune with the flow of the market a little bit, guys, you're going to take that 50-50 trade, that potential to break trade. And this plan is designed to optimize your chances of success with that 50-50 trade. This is the best of the best. This is the highest probability on a medium probability trade. And you might find ways to alter it with a little time, study, simulation, little feedback here and there. But guys, this is the best way initially. One area not broken. Don't force the market to get through 7 or 8 areas, right? Let it be one. Let momentum be what drives you. Make sure that it's from a strong top or bottom. And if you can mark yes to the first 3, here's the biggest killer of 50-50 trades, divergence, that loss of momentum. So it says in red, no divergence on the 5-1. Guys, if you mark yes to all of these, get in at the area the same way you would a high probability trend trade. And then it reminds you, if there's divergence, if you see that loss of momentum, that cyan line from a low, that magenta line from a high, the hell out of the trade. It's not your trade. And then your management's going to be a little different because it's not high probability trend trade, right? You're a chart reader now. You're going to manage a bit more aggressively. You're still going to use the idea of where the market shouldn't go. You're still going to use reversal bars. And then for the third time, if divergence prints, get out of the trade. Divergence kills 50-50s. That is the biggest killer of 50-50 trades ever. Your first profits are going to be at the first trouble spot or $100, whichever comes first. You might make 70 bucks on your first contract if that's where trouble is. Your chart reading will define it. And then quick profits on the second, guys. These aren't home run trades. These are trades that take advantage of the ability and the potential of an area to break. These are not clear path trades, so you can't behave as though they are. So guys, that's the KISS plan. That's the beginning. That's designed to get you into the market and give you the most laid back way ever to manage it. And guys, crude oil is stuck in between areas. And there's gold. And gold came down and had odds favorable. And gold came down and it reached those magenta 1-to-1s, which on gold are impactful. And it went beyond the correction point. Does everybody see it? Right beyond the correction point. If you took this gold trade, and I know that there's people that took it, you might have lost 50 bucks. If you traded into a termination condition, guys. Let's see if we can find one of those tails with odds favorable momentum. Just for grins. I'm going to circle the tail, and I am going to fudge a little bit. I'm going to ignore the fact that it's into trouble. But I just want to start recognizing patterns. There's a pullback. It didn't quite make the area because it's directly into the termination condition. Let's see if we can find one that fits the rules. There's that odds favorable and potential to break. Let me scroll back. Right to support. Right to support. Where'd it go? Right to support. Right on the top of the correction point. And that's what carried you off to the next area. So guys, you can go back and you can circle these trades. You can open up a large chart. Come on, large chart. And you can go back and say, let me find odds favorable momentum. Let me find a clear path. Let me circle that tail. And guys, a lot of you took this trade yesterday. Whoop, where'd it go? Sorry. Let me blow this up so you can see it. And if I scroll back and I find that circle, a lot of people got paid on this one yesterday. There it is. Right back to resistance, right inside of favorable large triggers. Guys, you're going to be tempted to look for every trade, look for the best trades. You're going to be tempted to break your rules because you're bored. Focus on the advantages. Are there any questions about the high probability trend trade? I know that I have new people in the room and I know that it's like talking another language. The easiest way to get to where you want to be is commit to the look of momentum first. Understand the look of momentum. Keep it simple, keep it focused. Go through the spreadsheet I gave you and look at 50 pictures of momentum so that you can identify it, both up and down. And then your next task is to understand the termination conditions. And then look for entries. Don't look for the trades until you've got the three concepts and then just link those concepts together. So guys, I'm going to take 5 minutes. That's my first hour. Obviously, there's not a lot going on in the market. Caught in between termination conditions, not a lot of posts in the room. When I come back, we're going to start to look at the charts that you guys have posted. I'm going to relay everything back to momentum, clear path, and entry area, no matter what kind of trade it is. Because even on the people that are a little more advanced, that are taking trades maybe without a clear path, you'll see that they're not sacrificing momentum. And it all goes back to momentum and a clear path, guys. It really does. So if you post in the room, tell me what you're thinking. Tell me what you see. Annotate your charts. Type all over them. Go back to those three concepts. Mark, here's my strong triggers. Look at the separation. Mark, price had not reached an area. I have a clear path. And there was my pullback right to resistance, right inside of favorable large triggers. And I took an exit here because I noticed that there was a third divergence and that may stop a trend. And guys, what we're going to do is we're just going to go through it and say, hey, great read. You had it. That's perfect. Look at your entry. Beautiful. Stop was virtually nothing. Way to get paid on the trade. Virtual high five. Or you're going to tell me that you had momentum and maybe there wasn't, right? And I have to say, okay, so let's go back and let's explore momentum. Let's talk about those strong triggers. Or let's talk about why this was a termination condition right here at 75.6. Let's talk about how jumping in down here gave you more risk than getting in at the areas inside. So every trade, every picture becomes a lesson. You get that feedback. And guys, I'm telling you right now, litter my room with pictures. Make me work for it. I'll be back in 5 minutes. Guys, go stretch your legs, pet the dog, do whatever you need to do. I'll see you guys in just a couple. Talk amongst yourselves. An hour. And I'm going to scroll up to the very top of the chat box. I want you guys to see this. I scroll up, whoops. And this is how I get to your pictures. So I go back and forth. I'm going to go up to the very top of the room. And I'm going to start looking at the pictures that you guys have posted. And then from those, we're just going to start a little bit of feedback and see what's going on in the world. So D had one yesterday, 213. And guys, this is one of the things I'll do. I'm more than happy to come back and take a look at the things that you post in the afternoon. If I ever miss them or you needed that feedback, let me know. But D posts a chart, and I love this because D says, hey, Mark, check it out. Odds favorable momentum, OFM. Small triggers are above the large with space between like scissors. Rule number 1 met. Absolutely beautiful. And she says, clear path, small and large above resistance. Rule number 2 met. And guys, the more you write this out, the more you take the time to associate words with the looks, the easier it becomes to recognize. And then finally on the small chart, D says entry at a pullback at an area inside of the triggers. And there it is right there. There's her entry like a sniper. And off it goes and she gets out of trouble. And D, what a beautiful trade. What an absolutely gorgeous trade. Dun, 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 62. There's only one thing, D. Are you with me? You entered on this tail, not on this tail. You entered at 26. So was it a clear path or was it a 50-50? It was a clear path of 26, but it was a 50-50 on 45. Does that make sense? It's a beautiful trade. It's a gorgeous trade. But it was, in fact, a 50-50. You take the perfect low-risk entry, and you're able to capitalize, and you're out at trouble. Outstanding. Beautiful, beautiful work. All right, let's see who's next. This is my favorite part of the day, getting to see what you guys do, getting to talk about it. Getting to see it. Andy sends one at 12:08 a.m. because Andy doesn't sleep. I'm convinced of this. Andy says, check it out, Mark. Odds favorable. The divergence, it's just a loss of momentum. The market reversed, right? Pivot from nowhere. So weak top. Let's call it a weak top, Andy, instead of a divergence that reversed the market because it didn't come from an area. So it's a weak top. You're going down. Everything is beautiful. I'm not even sure that's 50-50. It looks like you made it through resistance. No divergence, strong triggers. And your area inside of triggers is up here. And man, they just missed you. Beautiful look. Again, just didn't work out. Didn't quite get that fill. Man, they'll do that to you every now and then. Paul, same thing. Odds favorable, smalls break, beautiful, and you don't take it because of divergence, because the 50-50 KISS plan says don't take it because of divergence and a weak top, and the same thing is true right here, and man, it's hard, isn't it? It's hard to follow rules, especially when you're going back and seeing that it won anyway. Does that make sense? Guys, and this is one of the things that's going to happen. We did this yesterday. You're going to see it after the fact and be like, son of a gun, I could have made so much money on that 50-50 with divergence. We did this yesterday. Let's do it again today. And we'll just start with this one. That was a 50-50 right there. Let's see what that 50-50 looked like on the pullback. Get up there. Well, that one didn't have areas inside of favorable large triggers, right? There's no falling for it, D. I mean, 50-50s are a part of what we do. It's a lot of what we do. 50-50s can be outstanding trades, but let's go back and see what this one looked like. It's a part of it. I told you guys most of your trades are going to be medium probability. So there's divergences on a 50-50, and you'll notice that it failed, even momentarily, right? And then if we come back to this 50-50, and we scroll back, and guys, this is how the plans come to be. As I go back and look at 50-50s, And I keep noticing that divergence is the one common factor on the ones that fail. So what happens a lot, and Paul, just great job sticking to your plan, is you're going to come back after the fact and say, but it won anyway. You know what, Mark? That's not cool. This 50-51, even though it was from a weak bottom, even though it was from, even though it had divergence, but it's not about what it does the one time. It's about what happens if you take that picture 100 times. Do 70 of them win? If they do, that's when it becomes part of your plan, guys. So great job sticking to your plan, Paul. I know it's not easy, especially when you see it do what you thought it was going to do after the trade. And your brain's going to tell you, change your plan. You got to do something different. You can't miss this money because you may never get paid again. There may never be another trade, Paul. Break your rules. And then Paul knows, because he's got the experience, that there's always more trades. There's always more opportunities in the market. It's rare that the day goes by and there's not a trade or two. So great job, dude. And then this one, I'm going to do it just because I think this is pretty cool. Cheetah posted this. And this is just always funny because it's my brother's chart too. So first Cheetah posts, hey Mark, 3 divergences in the same price range may terminate the trend. And then he follows it up with, so how come this guy did it, right? And I know this wasn't what Cheetah was doing. He was looking for understanding. But how come this guy, this schmo, broke the rule, right? How come he did that? Why did he enter? And he wasn't playing trade police, but a lot of new users will. They're like, yeah, but he broke the rules, right? Fortunately, I speak very fluent John Novak. And there was a reason. It was a strong bottom that held. And he made the decision to manage through the divergences, guys. And as you grow with the indicators, your plan will grow too. But I thought that was pretty cool that Cheetah did that because he recognized the rules, which means that he understands the rules. And he questioned, why? How come? Why did he do this? And guys, I will always go back. I will always go back. I actually had to go back and find my brother's large chart. But does everybody see the termination at the bottom? This is how plans get built. Price reaches support, not one trigger breaks. Small triggers roll. Guys, this is a trade that Nexgen started teaching in 2004 to take advantage of strong tops and bottoms. And it's pretty cool. And if you just look at the chart, you're like, what the hell? But if you go back and you understand the chart read, it's the perfect entry on a great trade that Nexgen's been teaching for 20 years. So question everything. I love it. When you guys are like, how come, right? Sometimes the answer is because it's a part of his plan. Sometimes the answer is because that person has more repetition than you. That person has seen more patterns than you. That person understands a couple things a little different than you do, and that's okay. But I'll still try to get you the answers, and who knows, maybe it'll become your trade one day. And then Red Rob, let's see what you did. How's this look for an entry? Just an area inside of large triggers you'll be watching from 80.54. I don't know. Let's look at the rules. And Rob, just for the sake of the class, I'm gonna go after you a little bit on this one. Boom, boom, boom. I want you guys to see how if you get in the habit of annotating, things fall into place. So everybody in the room, work with me here. Did we have odds favorable momentum? Did we have small triggers above the large triggers? Were they wide? Was there space between the two? So there's a yes. Did we have a clear path? Price didn't reach resistance, right? We're above everything. What do you guys think? Rob, you know the answer. That's why you were looking for the entry. You did have a clear path. The mid-band's only a termination condition if the large triggers are a full bar away. So Can everyone see? Rule number 1 is met with strong triggers. Rule number 2 is met because we're not trading into a line on the large chart. Let's keep it as simple as possible. Is everybody good with that? Tattoo Timmy? This is the first part of it. This is setting yourself up to look for an entry. So let's change how's this look for an entry. And Rob, it's easier if you give me everything. A reversal bar printed, right? Here's the top of my triggers. Here's the bottom of my triggers. Here's the only line that falls within that range. Rob, I can't see your price bars. You said 54. Why? Let's refine your entry first. Your entry is about 58, yes? And then your stop goes on the other side of the triggers. So would that be a good entry at the mid band? All you have to do is say, is there an area inside of triggers? The answer is yes, the mid band. Stop goes 4 to 5 ticks below trigger lines. And there you go. So Rob, absolutely. You had the rules met, you pinpoint the entry, and you know where your stop goes. I'll give this one back to you in case you want to steal it. But this is one of the reasons why chart annotation is such a big deal. It's so easy to say, hey Mark, was that a trade? Hey Mark, was this a long? Hey Mark, was that a this? Was that a these, a those, a them? But if you always go back and you write the 3 things, right? Momentum, clear path, and an entry area. And the cool thing is if you're posted in the room under clear path, hell, I don't know, need help on that one. I don't know if I had a clear path. Then we open up for the clear path, right? Market went to 38, went to the wrong side of the correction point. And then Rob, that opens up another rule, not a rule, but do you notice how it's not coming from a good bottom? It's not coming from a termination that rolled the market. This becomes your first bounce point. And you don't have your synthetic triggers over here. There should have been a big fib right there. That was a termination condition. But Rob, what you don't have going on your chart right now are your synthetic fibs showing up over here. So you need to right click and make sure that you have tick replay activated, because you're only showing areas from your large chart on your large chart. And the one thing that gives such a huge advantage is the software is designed and your templates are set up that you're going to have fibs from your 5-1 chart, you're going to have fibs from your 21 chart, and you're going to have fibs from your 13 chart. And each and every one of those is valid. Each and every one of those is a line that could stop the market. So if you don't have those synthetics working, if you don't see this fib that's coming over from your 5-1, then you don't see that as a 50-50. You don't see that as problematic. So make sure that tick data is in there. And areas that weren't broken created a big untradeable bounce. It goes right back to the language that we use in termination conditions every day. But the way yours looks, absolutely. I would have taken that entry all day long and probably gotten stopped out. It doesn't make it the wrong trade, but you're missing just a couple of the tools that create advantages there. Good stuff, Rob. It's a great read, man. Your reads have been nothing but solid lately. Nothing but solid lately. All right, Andy, odds favorable, clear path, perfect entry, target one met, stopped out on the second. Great trading, Andy. Does everyone see it? There it is again. Odds favorable. Smalls above the large, larger wide, angled in the direction of the trend. Absolutely nothing in the way. He gets in at 42.4. He gets paid at 43.5, $110. And then he's out on the second one at 43 flat, another 6. That's $170 on a trade that essentially failed. Beautiful trading, Andy. And I like the entry. You had one line. One line. Absolutely perfect, dude. You know what I would do, ladies and gentlemen, is I would take this picture. And this is one of those ones that you might put in your favorite looks because it fits all the rules. I'm going to put it in the client trades. I'm going to put Andy in the Hall of Fame. That way people for the next year can come back and look at this high probability trend trade and hopefully replicate it and feel good about it. So we'll call it Andy's high probability trend trade long. And now it's in there forever. I can come back and I can study this. Steve Diego. Let's see what we have. Strong top. Strong triggers. I love this. It cleared trouble, but 50-50, so no. Well, then it didn't clear trouble, silly, right? Be very specific. It did not. It's very much a medium probability trade. It's an area that's not broken yet. And I love that. Rule 2 not met. Great job. So no divergence, perfect entry, stop where the market shouldn't go, paid, and when divergence prints on the 50-50, exit. With potential to pull back to large triggers, a better entry would be 2 ticks below fibs, which were just above the high line of the 10-2. Entered the area of the fibs. Area of the fibs. I love it. I love it. Steve, perfect. And the management, once again, guys, managing your trades. You don't have to have a home run every time. Nice job, Steve Diego. And then Andy, you know what? I want this one in my spreadsheet under the perfect 50-50. I just want to be able to type out Steve Diego. Awesome management needs to go in there because you couldn't have done the management any better. All right, Andy, let's see what you got. Guys, it's quiet in here. Can you still hear me? All right, so Andy, I have to ask, what are you not showing me down here? Because I can't see your large chart at all. You completely cut it off. You say you have odds favorable and a clear path, which is weird because you've got a fib at 45, which means it's probably a 50-50. 45.9, 45.9, maybe not. But probably. And you're taking a momentum style trade without momentum and really not a lot of room. I mean, great quick snap, pop, right? Not a lot of room to make any money there, but you still make money there. Nice job. I like it. Guys, when you're comfortable with the market, you're going to be amazed at the opportunities that you find. You're going to be amazed at what you can pull off. It's very different. It's very different than the high probability trend trade. It's still advantages. It's still recognition. It's still where the market is likely to continue. But your time recognizing patterns just creates more patterns. And it's one of the great things about what we do. Trades that I was terrified of when I first started are my everyday trades now. And guys, crude oil is just get out of that range, right? Just get out of that range. That's all we're waiting for. And guys, that's it for pictures. Perfect termination condition, 100%. Let's talk about the gap theory. I'm going to have to just make stuff up now. Morgan, it's been problematic for you. Now, when you say problematic, Morgan, is it possible? Is it possible? Well, it's only problematic if you're trading into them, right? It's only problematic if you're trading into those terminations. And yeah, it's volume is split with the roll tomorrow, for sure. Crude just does what it does. That's okay. And Rod just gave you a little insight on why. They're about to roll the contracts. Trading is the only business in the world where people get pissed off because they don't get to work. It's funny. I didn't do anything today. It's hilarious because it's so true. All right, guys, I want to give you, and this is the same condition when the midband behaves as a termination condition. And this is the gap theory. And I love this one. And all it says is that if price accelerates away from, I'm just going to do LT, large triggers, and hits an area, it's likely to close the gap back to them if they are a full bar away. So if price, let's see if we can do it like this a little bit. There we go. So when price accelerates away from those large triggers, does everyone see? It's just absolutely zooming. And the large triggers are way down here. This is your gap, guys. And all it says, it doesn't say go short. It doesn't say anything other than no long trades in the gap. It's like a vacuum sucking price back. Does anyone else have trouble spelling vacuum? It's two U's. Who does that? So guys, this is the gap theory. Yeah, 2 U's. That's one of my words. I've got like 5 words that I can never spell right. Vacuum is one of them. So this is one of those patterns. It's not even a trade, but what I'm going to do is I'm going to take it and I'm going to go to my spreadsheet. I'm going to go to patterns that repeat themselves. And I'm going to drop the gap theory in there. Because this is one of those things that if you go to the user guide, if you go to tops and bottoms, and you look at the areas that may stop the market, guys, the last one on there is that large chart midband if the large triggers are a full bar away. And once you have that, once you have those large triggers a full bar away, it says just don't go into them. Don't trade into them. And once again, it's just a bacon saver, guys. Rule number 2. Most broken. What do you guys want to talk about? With crude oil, here, let's do this. Let me show you how. On NinjaTrader 8, if you go new and market analyzer, and I'll give you the link to this as well. You have to right click on it and put a template in. So template, load, and there's only one to choose from on your software. And what this does for you is you can add the instrument. So I'm going to put the 0824 crude oil in there. And since it's not even in my list yet, I'm going to change it to 09. I'm going to put it in next month's. And I'm going to compare 08 to 09. And 08's still 2/3. But 47,000 of the volume has gone to September. So tomorrow, September is probably going to be better. Pete, I don't know what a VWAP is. But that's something that I'll do every time a market rolls, is I'll go through and I'll use that market analyzer so that I can go through. I've got maybe a 50-50 on resistance. So I don't know what your VWAP is, but I hope that it's awesome. Volume weighted average price. I have such an advantage of not having any knowledge prior to Nexgen, Pete, that I don't even think about these things. So Morgan, directly into resistance, weak triggers. You take the only line possible and make $160. Trading indetermination conditions with weak triggers because of a good bottom. You know what? If you're going to do it, have your reasons, right? Rob. And then you said that you got beat up for arbitrary stops. That's a good lesson, isn't it? It sucks to have to take that lesson, Morgan, but that's a great lesson. When you just arbitrarily put a stop and try to follow the market because you're afraid something's going to happen, the first thing is why did you move it? Because of that, because of these, because you weren't confident in the trade. Does that make sense? You didn't trust the trade. So the question is, why the hell did you take the trade? Because you were bored, because you were hoping, because you were wishing, you were wanting, you were praying. That's okay. Not mad at you for it. Guys, excuse me just 1 second. I do not want to clean up dog stuff. Back in a second.